Okay, here we go. This is the test question for Chapter 20, and it will be 1/3 of the part of Test 3. And as soon as we get it done, I'll record it. We'll have up to 100 points on this test, and we'll do it as we go through. So the first thing you have to look at here is make sure you understand the information they've given you. Again, this is found, where's the paper at? This is found, sure, it's problem set B, and it is problem 20-4 in your textbook. So if you wanted to look at it, you could get a really good view of it in your textbook, if I could find the textbook. I found the textbook, and I told you the wrong problem number. It is problem 20-4A, and it's found on page 910. I would print the front page of this and keep it handy as you go through this, because it will help a lot. What I'm going to do is I'm going to do the month of April for you on the throughout the test, and then you can go back and do May and June, because you're going to do the whole quarter, second quarter, and you'll have to do each month per the instructions here. So let's kind of begin. The very first thing we do is that sales budget, and the budgeted units are 20,500. This is all in the instructions. The unit price is $23.85. So the total budgeted dollars, okay, are $488,925. So that's your sales budget for April. Now you're going to come back and do May and June, and you're going to add this up, and you're going to add this up. So this gets us started on the production budget. So now we're looking at next month's. Now remember how we project? And we want to have an ending inventory for next month to begin with. In this case, they want 80%. So 80% of May's production schedule is going to be 19,500 times 80%, which gives us an ending inventory that we need of 15,600. We are going to make, according to the budget here, 20,000. We're going to sell 20,500 for April. So we're going to add that on. So our required units are now 36,100. And then we're going to deduct beginning units. And the beginning units, I think that was a given here. That is 16,400. If you take 80% of March unit, you will come up with 16,400. So now next time, what's our ending inventory going to be? It's this, but that becomes our beginning inventory down here, right? Inventory here becomes the beginning inventory down here. So don't forget that. So we have this, we're going to deduct that. So we have to produce 19,700 units. Now this is the number we're going to be using throughout when you're calculating direct materials and direct labor, because even though this is what we're selling, this is what we're making. And for May, this is a check figure. For May, you're going to have units to produce 19,900. So you're going to come back and you're going to calculate May and June now and come up with totals. So let's look at the raw materials budget. What do we do with that? Well, we know we're going to produce 19,700. There is 1/2 material per unit. So we'll multiply that times 50.5. And material needed for production is 9,850. Now, what was our ending inventory? Okay, we've got to go back, and so what do we have to add? So what's our ending inventory going to be for May? Well, that's where this number I gave you here becomes really important, because these are the units we have to produce, and we have to have 80% of those, I believe. We have to have an ending inventory to cover that. So we have 19,900 times 1/2, and we want to have 50% of that for materials inventory. So I'm going to multiply another 50% times that 9,950 and come up with our ending inventory. Raw materials inventory needs to be 4,975, because what you're going to end up doing here is bringing that 19,900 here. And this is the amount you're shooting for the ending inventory. And then our material required is going to be 14,825. We're going to deduct our beginning inventory. This was a given in the instructions, and that means we need to purchase 9,900 pounds of material, or whatever it is we're dealing with. And the price per unit is $20, so we have a total cost of $198,000. So that's our raw material for April. And then you're going to do the same thing with May. You'll take the number you have from production here, bring it to here, and start all over and do everything we did here. Now, what's our beginning inventory going to be here? Our beginning inventory is going to be that 4,975, and you'll have a new ending inventory from this amount. Does that kind of make sense? Okay, so we're going to keep going here. So now that you know how to do this, let's go to the direct labor. So how many units are we making? We're making 19,700. That's not right. That needs to be there. It's a half of an hour. It's needed for each unit. So we're going to multiply that times the units and come up with 9,850 hours. And we are going to use a labor rate of $15. So our direct labor budget is $147,750 at this point for April. You're going to do the same thing for May. How many units are they producing? Right? Multiply it out, and you're going to complete this budget. So now we're going to move to factory overhead. So you've done all of these. So how many labor hours were needed? Well, if you come back here, you'll find 9,850. We're going to multiply that by $2.70, and that's going to give us our budgeted variable overhead. And then we're going to add the fixed overhead to it and come up with $46,595 for the budgeted overhead. You'll do the same thing here when you get these hours and these hours. Just multiply them down. Then we move on to the expenses, and we look at budgeted sales. Well, what did we say the budgeted sales was? $488,925. It's an 8% sales commission. So that means we're going to have that sales commission expense. They tell us the sales salaries, so our total selling expenses are $42,114. Again, whatever the budgeted sales were here, multiplying that out gives you the total selling expenses. So there you have a selling expense budget. The next up is the general and administrative budget. They tell you salaries are $12,000. We are going to throw in the long-term note interest on this one. So we have total expenses of $16,500 for April for this. Now we do the tricky one. And that's going to be the cash receipts. How much money am I going to bring in here? Well, a couple of things you need to know. Here's your total sales, but only 30% of that's cash, okay? And 70% of it is credit. They do not collect any credit sales until the next month, and they collect it in full when they do collect it. So, here's what we brought in this month, okay? These are our cash sales. Now, it just happened that the month before this, March, was the very same sales. So, this credit sales is the same as March's. And we are going to collect all of those credit sales in this month of April, which gives us a total cash for $488,925. So that's what we received. This cash payments is everything AP after the month after purchase. If you look back on the, let's go back one more time here. Their accounts payable was $200,500, so they're going to pay all of that off. So that is an expenditure on the cash receipts and cash disbursements. So keep those numbers in mind, because now you're going to move and do a cash budget for April. It gives us the beginning balance, and that's on that very first instruction sheet. These are receipts from the cash schedule. That gives us a total available cash. Remember that $200,500 that we paid for AP? That goes there. This is from our direct labor budget. This is from our variable overhead budget. This is from our sales commission. This is from our sales salary. These are our gen and administrative salaries. There were no dividends, but there will be, I think, in May. So you'll have to watch that. This loan interest, I'm giving it to you. That's $12,000 at 1%. And there's your long-term note interest rate that came off the administration budget. So then we're going to add up all of these to find out our total cash disbursements. And it comes to $433,579. And if we subtract the disbursements from the receipts, we come up with a cash balance of $95,346. Now, it said if they went over that $40,000, I think it was the $40,000, they were going to repay that loan of $12,000, which they've done. So they have an ending cash balance of $83,346. And there's no loan because they paid it off. So there's no short-term loan. You're going to do the same thing for May and June after you go through this whole process. But first, okay, let me show you what you're really shooting for here. When you get all three of these complete, alright, you're going to create an income statement from all this information, and you're going to create retained earnings. You're going to add that on to come up with a new retained earnings. And then you're going to do a budgeted balance sheet. Now, the glory of all of this is when you get all done, here's the balance sheet so you can proof the numbers. If you have all the numbers on here correct, then everything else is correct. This will tell you what area you're going to, if you make a mistake, you will be wrong in, so that you can go back and figure out what went wrong along the way. So that is the test question in a nutshell. You need to finish each one of these in its entirety and then move on to the next using the example I've shown you. So give it a really good try, and we're going to talk about it on Monday when you come in, and we'll see how far we've gotten on it. I will be available all week for you to email me questions, okay? Along with this video, you're also going to get a new a new spreadsheet to do this with. Okay? Alrighty. Thank you. Have a good week.